Hi, this is Tom along with Daily FX, and I'd like to take a couple of minutes to talk about the trend of the market and trading in the direction of the trend. Now, the first thing I want to talk about is how we actually identify a trend on a chart. And what we recommend in our courses is start with a daily chart with about 1 year of trading activity on it. And we identify an uptrend as a series of higher highs and higher lows. We identify a downtrend as a series of lower highs and lower lows. And we want to trade in the direction of the trend. Otherwise, when we see an uptrend, we only want to look for buying opportunities. And when we see a downtrend, we only want to look for selling opportunities. Why? Because it's really just a matter of simple math. This trending move from A up to B could be about 1,000 pips on a daily chart. And the move against the trend from B down to C could be about 500 pips. Okay, it's a stair-step formation going up, so the moves from A to B, the trending moves, are going to be larger than the counter-trend moves, which are down B to C. Now, if this is 1,000 pips and the move against the trend is 500 pips, it's just simple math. That if we're buying in an uptrend, the odds are greater that we're going to be in a more profitable trade because of the bigger moves moving up. Okay, so if there's 1,000 pips moving up and 500 pips moving down, that's almost twice as much chance of being in on more up pips than down pips on the trade. But how do we identify getting into the trade? Okay. Now, this is known as an ABC move. Some people call it a 1, 2, 3 move, but it's basically the same thing. Where from A to B is the trending move, and B down to C is the move against the trend or the counter trend move. And there's really two approaches to trading this. One of them is just to buy as the market moves up through the previous high, which is point B. This is called a breakout trade. Otherwise, the market breaks out up to new highs. And the other way of doing it is people like to buy the pullbacks. This is what's mean as buying the dips in an uptrend or buying the pullbacks. Otherwise, they look to sell either at point C or just above point C. Okay? Now, this is when people would use their technical indicators to identify that entry into the trade in the direction of the trend. Otherwise, if you're using stochastics or RSI, you'll see the move below 20 on stochastics and the crossover, or the move on RSI below 30 and then the move back above 30. That's usually associated with these moves, these reversals off of point C in an uptrend. Okay? Now, this method also gives us a good point for our protective stop level, because remember, we always want to trade with a protective stop in the market. That if we see the RSI or our indicator show the reversal here at point C and we get in right after point C, we actually want to put a protective stop in below this low, which is actually point C. Because at this point, if the market moves down to print a new low, we want to be out of our buy side trade at that time because something's changed in the market, usually a news event or some other event that's actually caused the sellers to come back in and take control of the market. When the sellers are in charge of the market, we don't want to be on the buy side, we want to be on the sell side. But of course, since it's against the trend, we just let it play out and perhaps try to enter again after we see another reversal on that. But it works the same thing on the sell side. Otherwise, from A down to B and the counter trend move to C, again, the breakout would be as the market moves down through support, which is point B, or if we want to sell the rally up to resistance in a downtrend, that would be trying to time our entry at point C. And again, we would want to use technical indicators or Fibonacci retracements or any other technical tool to identify when to get into the trade. Okay, but first we want to identify the trend. We want to look for a trade in the direction of the trend, and then we want to use our technical indicators to help identify that entry. Okay, when we're trading in the direction of the trend, there's a lot of room for error in our entries and exits. If you decide you want to try to pick tops and bottoms and trade against a trend, you really have to be exact in your entry and exit to be consistently profitable, which might be a little bit too much to ask because markets can do whatever they want, whenever they want. So we want to trade with the momentum of the market. When the market's in an uptrend, we want to look for buy trades only. When the market's in a downtrend, we want to look for sell trades only. And what I like to do is I like to go through all of the currency pairs that are available to trade at FXCM, all the daily charts with 1 year of trading, and look for the strongest trending moves. Okay? Because there's a lot of times you can look at a currency pair, the daily chart, and make a case for either an uptrend or a downtrend. There's arguments for both sides. Those are the pairs that I like to stay away from because I think the trade is just going to be as directionless and unsure about which way it wants to go. Okay? But if we find the strongest uptrends and look for buying opportunities, and find the strongest downtrends and look for selling opportunities, we do increase our chance of success, and just about everything we do can fall right into place when we're trading with the strongest trending moves. Thank you very much. Again, my name is Tom Long with Daily FX, and good luck with your trading.